Welcome to TheoTrade. This is Don Kaufman. It is April 25th, 2016. Front and center. Apple. There are earnings coming out Tuesday after the bell. What better time to talk about it than, of course, on a Monday afternoon over here. Yeah, Apple is actually taking, again, kind of center stage in the entire earnings extravaganza, following, of course, some disappointing numbers and really disappointing trading Google last week, which, again, bestilled my heart. Shocking to me that Google didn't take the rest of the marketplace with it because, again, last, Friday we had Google trade down big, Microsoft trade down big. Facebook, which has earnings later this week, even traded down big last week, but nothing in the broader markets. Apple, though, takes center stage. And again, this week, we're not just packed with earnings announcements. We also have an FOMC announcement coming out on Wednesday. So Janet Yellen, who I very often refer to as Punxsutawney Phil. Yes, that's the groundhog. Will she see her shadow? Or will interest rates change? Right now, the probability the markets are giving, it's only like a 3% probability that they're going to do something. Doesn't mean the language, but 3% probability. Nevertheless, Apple. Let's hop in. Let's look a little bit at Apple. What I see, what I don't see in here. First and foremost, I like to open up this option statistics on thinkorswim. 436,000 contracts traded today. Sounds like a lot. But when you look over at this sizzle index, and it's worth taking a little bit of time once in a while, hey, do some homework if you're going to place a trade, especially around earnings. And that's exactly what I'm going to do for you in today's video here. So first of all, volume throughout the entire marketplace today was light, but specific to what's called the sizzle index. And sizzle, it's proprietary to thinkorswim, to TD Ameritrade. And what it means by 0.89, or let's just say 90%, means that Apple today traded only about 90% of its options volume versus the previous 5-day option volume. So it didn't even trade the same option volume that it averaged all of last week is what it's saying. So volume was rather light. Now, I'll beg to differ tomorrow. Tomorrow is place your bets day before the earnings announcement. So let's dig a little bit deeper into the earnings announcement. Now, you're not going to see me go to a lot of charts very often, I'm not a market technician. However, I do have a very deep respect for statistics prior to an earnings announcement. And one of the first measurements that I'm going to look at, one of the statistical measurements I will look at, is what's termed expected move. So if you've tuned into any of these videos, you've seen me talk about expected move. Here happens to be the expected move for Apple. Now that's throughout the rest of this week. So that's the 4-day expiration. It's about $4, and 85 cents. That's a probability of expiring inside of that range. If you're not familiar with the probability of expiring inside the range, what it ultimately says is here's Apple at 105, right? All right, so here's Apple 105. It can move up about $4 or down about $4. I know it's 485, up or down, and it'll stay in this range about 68.3% of the time. That's what that means. Nothing more, nothing less. And how does it equate to that? It uses the at-the-money option prices. So if you add up the 105 calls, which are basically trading for $250, and add up the 105 puts, which are almost trading for $250, it pretty much comes out to about $4.85. Great. How does that help me? Well, that $4.85, one of the things that I'll teach people to go through is, what does that really break down to percentage terms? Well, so how do you do this? You just take the $4, and 85 cents, divided by the stock price, which is roughly 105, equals, and you're like 0.04. It's about a 4.6% move that's being implied. But a 4.6% move that's being implied, and you're like, okay, now what do I do? All right. Well, I'm going to do this for you. So what I did is I ran through a whole lot of data. How do I do it? A numbers cruncher. All right. And I've written some pretty good, thinkorswim codes over the years. So we take what we know. What do we know? The market is anticipating over the next 4 days about a 4 4.6% move in Apple, either up or down, right? So the market anticipates 4.6% move either up or down. Well, I looked back through 3 years of earnings data. And what we found in 3 years of earnings data is that Apple actually moved 4.22% following any earnings announcement. So the day after the earnings announcement, it moved approximately 4.22%. What it ultimately tells you is if you sell options premium about $5 out of the money, statistically speaking, that should work on Apple. Statistically speaking. I mean, what's going to happen to the other, whenever I say like 68% of the time, initially you should say like, well, what's going to happen to me the other 32% of the time? And that means we're going to move outside of the range. But again, for 3 years of data, we've averaged about a 4.22% move, okay, on Apple following the earnings announcement. Great. But it's pricing options right now at 4.6%. So there's a little bit of wiggle room in here. However, it's a very minute amount of wiggle room. There isn't, what I'm getting in here, there isn't any statistical edge per se in this trade. And that's what everybody's looking for. And people always get you to try to believe like, you got to trade the earnings announcement. Listen, you want to take earnings announcements, you take shots. This isn't a shot. This is looking at actual option pricing right now versus the statistical average of moves over the last 3 years. What does it come out to? In here, there's like a 0.4% edge. Transaction costs alone are going to negate your trade at 0.4% edge. It's not even a 0.4% edge. So where do you go from here? Well, again, should you buy option premium? Should you sell option premium? And the irony is that the market's actually pricing, we're probably going to move almost right to the $4.82. That doesn't mean we can't move outside of that range. However, there is one interesting aspect. Here's a 1-year chart, okay, of Apple. Again, I'm looking at a chart. Oh, no! Well, there is one interesting thing in the 1-year chart, and that is statistically speaking, if you take a look, all right, and you want to trade around odds, here's one earnings announcement we traded down, 2 earnings announcements we traded down, 3 earnings announcements we traded down. Here's going to be the 4th. Okay? If you want to take a shot, again, Apple for years trended to the upside after earnings. Now trends to the downside after the earnings announcement. And you can go look up some of this data yourself. Now, this takes, again, tremendous amount of calculation, but you go back to like over 5 years. And you start looking at Apple and how many times in a row, here it traded up after earnings, here it traded up after earnings, here it traded up after earnings. Okay, here did buck the trend. It bucked the trend in this one, but then traded up after earnings. Okay, here, all right, the absolute peak of Apple and the downfall. Here we go, started trading down around earnings. Now, as you start to come into more recent times, and again, traded down around earnings, traded down around earnings, traded down after earnings, traded where? All right. If you want to place that bet over there and trades down after earnings, you can go for it. Use what they call an in-out spread to do so. The in-out spread, just wrap around the strike price. That's like the 106, for instance, 104 put spread. Just take an easy risk a buck to make a buck kind of bet. Buy the 106s, sell the 104s against it. However many contracts do it for the 4-day expiration. It'll cost you about $1. Risk a buck to be able to make a buck. It's a shot. Because I'm telling you right now, statistically speaking, selling premium, anybody that tells you to sell premium around that earnings announcement didn't run the same calculations that I did. I looked back through it. Again, the market right now is pricing in about a 4.6% move. And Apple moves 4.2% based on the last 3 years of earnings. So I'm not going to sell premium. I'm not going to buy premium in there. What I'm going to do is take a directional bet. I'm going to do the 106, 104 put spread coming into it. It's a bearish trade. Oh, I like the bear. I like the bear nevertheless. Okay. Apple, it's trend-worthy. Trend-worthy around the earnings. Thanks a lot, everybody, for joining us here at TheoTrade. I'll be back on within our chat room doing an Options 201 course all this week. Options 201, what is it? It's the essentials. It's vertical spreads, just like I talked about a moment ago. It's calendar spreads. So it's the building blocks of all options trading. We're doing the Options 201 class all throughout the course of this week. It's 9:45 a.m. okay, to 10:30 Central Time. Again, that is 9:45 a.m. to 10:30 Central Time. That is the time we are doing it live. Or catch Options 201, really what we call the essentials, verticals, and calendars. Catch us in the archive. Thanks, everybody, again, for joining us here at TheoTrade.